Hi everyone, my name is Dharmo Soejanto and I'm the Chief Investment Strategist. It has been a difficult quarter to say the least, with all major asset classes down for the quarter. Global equities fell 4%. This is the third consecutive quarter of loss. The last time where stock markets saw 3 quarters of consecutive losses was during the global financial crisis in 2008. These show that we are truly in exceptional times. Bonds did not perform any better as US Treasury yields surged over the quarter. Some investors were hoping that the US Federal Reserve would pause its tightening. This did not happen, and Federal Chairman Jerome Powell, in fact, reiterated that the central bank would do whatever it takes to quell inflation, despite hits to consumers and businesses. As a result, global bonds lost as much as global equities for the quarter. Asian investment-grade bonds were largely flat over the quarter, while Asian equities were down more than 10%. In China, worries about further COVID-19 lockdowns weakened market sentiment. The property market disarray that also showed little signs of recovery. The rest of the North Asian markets also came in weaker because of concerns over slowing economic growth and an overall downturn in the global technology cycle. The very conservative portfolio, which declined 2.6% for the quarter, was weighed down by Asian equities and global bonds. However, being out of US equities before they were sold off in August helped to mitigate losses. The conservative and moderate portfolios suffered losses of 3.4% and 4.6% respectively for the quarter due to negative contribution from global and Asian equities, as well as global bonds. Similar to the very conservative portfolio, the two portfolios also avoided losses by being out of US equities before they were sold off in August. The aggressive and very aggressive portfolio, which fell 5.8% and 6.6% respectively, was similarly dragged down by allocations to global and Asian equities. The very aggressive portfolio had a larger detraction due to the larger allocation to Asian equities, which performed worse than global equities. The ESG portfolios generally performed better. The very conservative ESG portfolio suffered 1.8% losses during the quarter, mainly due to allocations to Asian equities and US REITs. However, being out of US equities before they were sold off in August mitigated losses. The conservative and moderate ESG portfolios suffered losses of 2.5% and 4.5% respectively due to negative contributions from global and Asian equities. The green bond allocation performed better relative to the broad bond index and contributed to performance. The portfolios also avoided losses from being out of US equities before they were sold off in August. The aggressive and very aggressive ESG portfolios, which fell 6.6% and 7.5% respectively, were similarly dragged down by allocations to global and Asian equities. The very aggressive portfolio had a larger detraction due to the larger allocation to Asian equities, which performed worse than global equities. As Asian equities tend to be more volatile, we have constrained the allocation of Asian equities to 15% and 20% respectively for the aggressive and very aggressive portfolio in the latest rebalancing exercise. Over the longer term, we have increased our expected return for most asset classes as valuations have become more attractive. On the other hand, short-term volatility has also increased. So for now, we are reducing our equity exposures and increasing our high-grade bonds exposure across the portfolios. (2022) is a very complicated year for markets. We have had conflicting signals. Strong job market signals a possible mild slowdown, while the stock market is pricing a deeper recession. As such, we expect equities to be volatile and range-bound for the rest of the year before beginning any sustained recovery. For bonds, we are still neutral, but we are becoming more positive as yields climb and approach peak rates. We continue to expect the US dollar to be supported on the back of relative tighter monetary policy in the US compared to other regions. Chinese equities is trading at a significant discount to global equities, and we continue to see Chinese equities as being attractive. As always, we encourage investors to take advantage of the market weakness by dollar cost averaging and staying invested through these volatile times. Thank you for listening and for your continued support.